Have you ever wondered what risks lurk beneath the surface of the global economy and stock markets? It's an intriguing question, isn't it? The world's economic and financial systems are vast, complex, and deeply interwoven. The global economy and stock markets are like two sides of the same coin, each affecting and reflecting the other. This intricate interplay makes it crucial for us to understand the potential risks that could send shockwaves through these systems. Whether you're an economist, investor, or just someone curious about the world, it's essential to keep an eye on these lurking risks. They can impact everything from your personal investments to the overall health and stability of the global economy. In this video, we will delve into the top 5 risks that may shake the global economy and stock markets in 2024. So, let's embark on this journey together and unveil the unseen threats that could potentially reshape our financial future. The first risk we examine is the rise in interest rates. This is a double-edged sword, really. On one hand, it's a sign of a robust economy. On the other, it can be a harbinger of potential economic turbulence. Let's dive a bit deeper. Interest rates are essentially the cost of borrowing money. When they rise, borrowing becomes more expensive, which can slow down economic activity. People and businesses may cut back on spending, which can lead to slower growth. In the world of stocks, this can translate into lower corporate profits, which can then lead to a drop in stock prices. Now you might be wondering, isn't a rise in interest rates good for investors? Yes, it can be. Higher interest rates can mean higher returns on bonds and other fixed income investments. But remember, we're talking about the stock market here. And in this arena, rising interest rates can make bonds more attractive compared to riskier stocks, leading investors to shift their money, which can cause stock prices to fall. Let's take a quick journey back in time. Consider the period of the late 80s. The Federal Reserve had been hiking up interest rates to combat inflation. But this led to the stock market crash of 1987. Or take the early 2000s, when a series of interest rate hikes by the Fed was followed by the burst of the dot-com bubble. These are just a couple of examples, but history is riddled with such instances. So what's the takeaway here? It's this: rising interest rates can be a sign of a strong economy, but they can also lead to economic slowdown and stock market instability. As an investor, it's important to keep an eye on interest rate trends, understand their implications, and adjust your strategies accordingly. Thus, rising interest rates, though a sign of a healthy economy, can pose significant risks to the stock markets. As we move on to the next risk, keep in mind that understanding these dynamics is a key part of being an informed investor and navigating the ever-changing economic landscape. The second risk that could destabilize the global economy and stock markets is inflation. Inflation, a word that's often thrown around in financial circles, is a beast that economists and traders alike keep a wary eye on. But why? To understand that, let's first break down what inflation actually is. Simply put, inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. It's like a slow-motion robbery. Money in your pocket today is worth less tomorrow. But how does this tie into the economy and stock markets? Well, it's quite straightforward. Inflation erodes the value of money. This means that consumers, you and me, can buy less with the same amount of money. This decrease in purchasing power can lead to a reduction in consumer spending, which is a key driver of economic growth. Now let's talk about companies. Businesses need to buy raw materials to produce goods and services. When inflation is high, the cost of these materials rises. This can squeeze profit margins, making companies less profitable. In turn, this can lead to lower stock prices, affecting stock markets worldwide. Furthermore, central banks often respond to high inflation by raising interest rates, which we've already discussed is a risk in itself. Higher interest rates can make borrowing more expensive for companies, potentially leading to reduced investment and slower economic growth. But here's a twist. Not all inflation is bad. A little inflation is actually good for the economy. It encourages spending and investment, as people prefer to buy and invest today when they expect prices to be higher tomorrow. So it's all about balance. However, when inflation is too high or too volatile, it becomes a risk. It can lead to economic instability and financial market turbulence. A sudden spike in inflation can cause panic, leading to rapid selling in stock markets and a sharp contraction in economic activity. Inflation, therefore, remains a perennial risk to the global economy and stock markets. Third on our list is geopolitical risks. Now, what exactly do we mean by geopolitical risks? In a nutshell, they are the potential threats to the global economy and stock markets that arise from political actions or instability in various countries around the world. These can range from trade wars and sanctions to full-blown military conflicts. Let's take a closer look. When countries engage in trade wars or impose sanctions, it can disrupt the global supply chain. This could lead to an increase in the cost of goods and services, which can then trickle down to affect both emerging and established markets. Think about it. If the cost of raw materials goes up due to a trade war, companies might have to increase the prices of their products to compensate. This could lead to a decrease in demand, potentially causing a dip in the stock markets. But it's not just trade wars and sanctions. Unrest and political instability can also have a significant impact. When there's political turmoil in a country, it can lead to uncertainty and volatility in the markets. Investors don't like uncertainty. It's like trying to navigate through a fog. It makes it harder for them to make informed decisions, which can lead to increased market volatility. And then there's the risk of military conflicts. These can have a devastating impact on the global economy and stock markets. Not only do they disrupt trade, but they can also lead to a loss of human life and damage infrastructure, which can have long-term economic effects. And let's not forget about the potential impact on oil prices. Geopolitical risks in oil-rich regions can lead to fluctuations in oil prices, which can have a ripple effect on the global economy and stock markets. In essence, geopolitical risks are like a game of chess, where the moves of one player can have far-reaching effects on the entire board. And just like in chess, the outcomes of these risks are often unpredictable, adding another layer of complexity to the global economic landscape. Geopolitical risks, unpredictable as they are, can have a substantial impact on the global economy and stock markets. The fourth risk is technological disruptions. We live in an era of rapid technological advancements. These advancements, as exciting as they are, can also serve as a double-edged sword. On one side, they create new industries and opportunities, driving growth. However, on the flip side, they can disrupt traditional industries, causing market volatility. Think about the rise of e-commerce giants, which has caused a significant shift in retail. Or consider the advent of electric vehicles, shaking the very foundations of the centuries-old auto industry. And what about the burgeoning field of artificial intelligence? It's poised to revolutionize everything from healthcare to finance. But with each of these advancements, there's a potential for upheaval. Industries struggle to adapt, jobs are lost, and economies can falter. This is especially true in emerging markets, where the pace of change can outstrip the ability to adapt. Therefore, technological disruptions pose a significant risk to the global economy and stock markets. The fifth and final risk we discussed today is climate change. As our planet's thermostat continues to rise, this global issue is seeping into the world of finance. Climate change affects all sectors, from agriculture to real estate, and the costs of mitigation and adaptation are staggering. It's a double-edged sword. On one hand, policies designed to combat climate change like carbon pricing or green energy subsidies can disrupt established markets and create new ones. This could lead to economic uncertainty and volatility. On the other hand, the transition to a low-carbon economy presents a wealth of opportunities for innovation and investment. However, the balance is delicate. If not managed strategically, the economic fallout from climate change could be severe. We're talking about a potential decline in asset values, increased costs of doing business, and financial instability. Climate change, thus, is a substantial risk to the global economy and stock markets. To wrap up our discussion, let's succinctly revisit the top 5 risks faced by the global economy and stock markets in 2024. Firstly, we have rising interest rates. As central banks worldwide tighten their monetary policies, interest rates are on an upward trajectory. This increase can put pressure on businesses that rely heavily on borrowing, potentially causing a ripple effect on the global economy and stock markets. In the second place, we have inflation. With the cost of goods and services steadily rising, the purchasing power of consumers is diminishing. This inflationary trend could lead to a decrease in consumer spending, which in turn could negatively impact economic growth and stock market performance. Thirdly, geopolitical risks are a significant concern. Conflicts and tensions between nations can create instability, not only politically but economically as well. This uncertainty can lead to market volatility, affecting investor confidence and stock market values. The fourth risk is technological disruptions. As the world becomes more digitized and interconnected, the risks associated with cyber attacks, data breaches, and technological failures increase. These disruptions can have far-reaching effects impacting businesses, economies, and stock markets globally. Finally, we have climate change. This global challenge presents a host of risks to the economy and stock markets, from disruptions in supply chains due to extreme weather events to the transition risks associated with shifting to a low-carbon economy. Climate change is a risk that cannot be ignored. In conclusion, these 5 risks, rising interest rates, inflation, geopolitical risks, technological disruptions, and climate change, are the key challenges that the global economy and stock markets face in 2024. Understanding these risks is crucial to making informed decisions and strategies. Stay informed, stay prepared, and keep an eye on these risks as you navigate the global economy and stock markets in 2024.